if China's economy is suffering, obviously they're the second biggest economy in the globe. That is a major concern for global trade, and if we're going to head into a global recession at some point.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. David, show 350. Congratulations.
Man, that is amazing. I didn't even know until you told me this morning. I didn't realize that. This is our 350th show. That means we're getting old.
Well, it does. I've been along for most of that ride.
Oh, that's a lot of content. I guess we say, you've been along for a lot of those. So,
yeah.
But that is pretty cool. So, woohoo! Celebrate 350. All right.
Well, and thank you to all the listeners out there too. We have pretty loyal listenership out there, and now viewership, I guess. In the
absolutely.
age of the
YouTube is
channel.
really starting to take off as well. So, thank you for those that download, and you can listen to the show via podcast on iHeart, Spotify, Apple, whatever you get podcasts. You can pick the show up there as well, and it's just nice to see our reach grow and get more and more people involved. So
350 so far, and the best is yet to come.
Absolutely,
starting right now. Hey, we'll get to the news as always, David. I want to know what you think about the next Treasury Secretary, but first, we have our regular drumbeat of classes and workshops and so forth. But we are moving into holiday season. Thanksgiving's right around the corner, and then, of course, we move into the Christmas season. We had about 24 clients come in for one of our Fall Fun Fridays, as we call it, Operation Shoebox. Tell the folks, we may have mentioned this before, but we've got a nice picture. If you're watching on YouTube, you can see this. What does that picture represent right there?
So, Samaritan's Purse, which is an organization founded by Franklin Graham, Billy Graham's son, out of Charlotte, North Carolina. They are an amazing organization that just reaches all around the globe and just helps people in need. They are a faith-based organization, but that doesn't stop them from serving anybody, anywhere. Amazing response during COVID. But one of the projects they've been doing for years, and my wife and I have personally been doing this for over 15 years, is called Operation Shoebox. And basically, you fill up a shoebox full of stuff that can be delivered to a child in need somewhere around the world, typically in third world countries, that have most likely never received a gift of any kind in their life. And the cool thing now is you can actually track your boxes. And so you don't have to buy the boxes. We actually buy the boxes from Samaritan's Purse. They have these pre-made boxes, but you can do a shoebox. You can do a Tupperware container about the size of that. My kids used to fill it and love it. At our church, we collected them. And so we've just expanded this year after year after year. And this is something I just feel called to do. So we kind of pay for everything to do it. We just ask our clients to come and volunteer to help stuff them, because there's some work involved here, stuffing over 100 boxes, if you will. And it's gotten bigger and bigger every year. And so I'm really excited what we'll try to do, how big we'll pull it off next year. So just a lot of fun. And you can see the joy on these faces. There's videotape of some of these kids receiving these boxes.
A child is a child is a child. All races, ethnicities, nationalities, all over the world. They jump up and down, smiling with their boxes. They're so happy to get something. And speaking of joy, our clients, one of the things I enjoyed most about it is our clients loved it. I mean, there was a great mojo. There was a great spirit.
Well, they donated, the only thing I asked them if they felt called to do it, if they wanted to donate to Samaritan's Purse to cover postage, because each one of these boxes, it's about $5 in expense to get it shipped somewhere around the globe. And our clients gave over $800 towards the postage of this box.
I wasn't aware of that. Oh, my gosh.
So we're going to actually match that. So we're going to send, a matching donation of what our clients collected. I'll get the final number from Abby, what it is, and then deliver all those boxes. You're going to take care of that for us. So
no problem. That'll be a labor of love. Listen, so thank you, clients who helped out on that. You mentioned before, David, we're sponsoring 5 red kettles in the metro area for the Salvation Army. So look for us out there.
Yeah, we kind of do a lot of our charitable giving pops up at obviously this time of year. It's center of mind for a lot of folks, and of course, so we have Open Door Mission joining us on the show later. So.
Kristen Dineen will join us in the second segment. Just had a successful local radiothon for Open Door Mission, but the needs continue through the holidays and beyond at Open Door Mission. We'll visit with Kristen in the next segment. All right, David, into the news we go. You told the team that as President-elect Donald Trump is filling out his cabinet, or at least proposing people for his cabinet, the financial world is watching and waiting to see who the next Treasury Secretary is going to be. Is there a favorite candidate for you, and what are the implications going to be?
Well, what I would like to see is more of an outsider than anything. In other words, I like
Some of the other
cabinet
picks certainly have been what we would call outsiders.
I think Americans of all political persuasion are fed up with the status quo. Our government is a grossly inefficient, right? So we need to get seriously efficient with our government. And listen, our government is there to provide certain safety nets to society, but it's there to provide the basic necessities, roads, defense, et cetera. But we have so much waste and fraud within our government. It's absolutely ridiculous, and nothing seems to happen to it. And I think I at least feel sense that may change here in this next administration. So yeah, so as we're laying out the cabinet, we're seeing some disruptive picks. But the Treasury Secretary is really important because that's going to validate how Wall Street looks at this administration. It may change M&A activity, mergers and acquisitions. It may change a lot in the bond market on basically how many bonds are issued by corporations, not just the government, et cetera. So the pick that would have been the most of the outsider, the kind of the top four candidates, if you will, was actually announced, and then it was the papers got it wrong. He was actually announced as the Commerce Secretary, and that is Howard Lutnick, who is the CEO of a company called Cantor Fitzgerald. In full disclosure, we do use Cantor Fitzgerald products sometimes for our clients. They've been around a long time, and he kind of rose to fame. He actually had a doctor's appointment on 9/11, so he was not in the building where his partner was unfortunately perished, and most of their employees. And so Cantor Fitzgerald does a huge charitable day every year. All the revenue from that day gives back to the families and the children and grandchildren of 9/11 victims. But anyway, so we are seeing some outside people brought in. We don't have the pick as of this recording on this, so we'll talk about this more here. Probably by next recording, we'll actually know who the Treasury Secretary is and what that will mean for the financial markets.
Speaking of the markets, let's look across the pond to Europe for a second, David. CNBC headline, Europe markets closed 2% lower, logging worst daily falls since August as mining stocks slide. What does that tell you?
So this was post-election, right? So, about a week after our election here. So this is a couple of days back. And Europe is reacting to our election. And if you didn't know, Europe if you polled them, were strongly in Kamala's favor on the election. And that's simply because our government bails out a lot of countries in Europe. We fund a lot of NATO, right? Excessively overfund. And this is a problem, in particular in Germany, who's actually already in a recession. So Germany's in a real recession right now, and they're continuing to struggle. I mean, they had a Volkswagen plant just shut down first time in over 100 years, right? So they are struggling. Now, Germany fiscally was the strongest house in Europe, so to speak, right? And they've kind of gotten their fiscal house in order, so to speak. They have the less of a debt burden than most of Europe right now, and they kind of I forget Schwarzenau or whatever. They want this balanced budget going forward. There's people have spoken in elections, and they don't want them excessively taking on debt. But now they're in a recession. The only thing they've known for the last 20 years is pull out the bazooka and fire free money at the economy. And so if our economy is still strong, as people say, and theirs isn't, the Trump election is bad news for Europe and good news for the U.S. Because that means we're going to try and pull jobs back here versus jobs that may have gone over there. So in the end, it's just bad news for the European economy in general.
Well, back here at home, David, Greenlight's David Einhorn says the markets are broken and getting worse. That's another CNBC headline. Sometimes I get confused, David. I thought market performance has been the one constant good news story in the financial world.
Okay, so what Einhorn is talking about here is David, is he's a value investor, right? Much like Warren Buffett, a little different style to the way he goes about it. And what they're doing is they're trying to find things that the normal investor can't get a hold of, right? They want to find something they think is mispriced, undervalued, can invest in that, then go in and lean on the corporation and tell them how to make their company more efficient, increase earnings and profits, and then that will obviously increase the value of the stock. So that's how they make money. What he's talking about, how the markets are broken, is so much money is now pouring in through passive investment vehicles, typically ETFs or mutual funds that are just index funds in general, that people are investing regardless of valuation. Like the markets are at a ridiculous valuation by any normal standard today, right? And they're actually like what we call the Warren Buffett indicator. I put that chart out in our to the team this week.
We have somebody who has a question about that this week too.
Okay, yeah. So maybe we can pull that chart up for that question. But basically, the market is about 202% of value of where it should be under normal circumstances. And by any measure, the earnings of the S&P 500 keep getting reduced for the next 12 months. Right now, they're estimated by the most consensus estimates to be about $274. Well, historically, the S&P 500 trades at about 17 times earnings, Chip. So, sorry, doing some quick math in my head here. That would be about 4,660 points, give or take a point. Sorry, I'm doing that really fast math. The S&P is trading at almost 6,000 points as we sit here. So is the market overvalued?
Even I can see that disparity.
All right, yeah. So 1,200 points there. That would be a pretty severe drawdown. So, but passive investors that just buy an index fund don't care. They just follow it, and those index funds. So what's going to happen is if the handful of stocks, and it's been basically 10 stocks in the last 6 or 7 years, have just pulled the whole indexes up. If those correct, if they go in the different direction, what's going to happen to all those funds? And so now the problem is the market can run further in the bull runs, but when it corrects more severe. And all you have to do is go back and look at the last 3 bear markets. COVID, we went down 37%. 2008, 2009, we went down 57%, and we went down 59% in 2000, 2001, 2002. So what he's talking about is over the last 40 years, how this has shifted, and this is damaging because the average retail investor doesn't know how to risk protect in that environment. So my message is make sure you understand how much risk is in your portfolio. If you've hit the home run, if you scored enough scores to win the game, do you want to keep taking risk, right? Or should you kneel on the ball, right? Or just like a football
Victory
analogy.
formation.
Yeah. So we want people to understand if you've already scored enough money to retire successfully, certainly you still want to grow for inflation, but maybe you don't want to take as much risk as you currently are. And we have a way to show you. We can evaluate that risk complementary and just show you what you might be, risking if that's something that interests you.
Up next, Retire Smart supports numerous local charities. One of them is the Open Door Mission. Kristen Dineen, Marketing and Communications Manager at the Open Door Mission, joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. She was a longtime and beloved on-air personality on local Christian radio. Now she's the Marketing and Communications Manager at the Open Door Mission. David, please welcome to the show our special guest, Kristen Dineen.
Thank you so much, Chip. Yeah, once again in the studio, we have our friend Kristin from Open Door Mission, one of the great charities here in Omaha that serves our community so well. And we are blessed to participate in 2 basically main campaigns you guys do every year. So if you want to kind of talk about what we did in the summer, let our listeners know, what that campaign was about.
Well, you helped us out with our Campless Care, and that's where kids are sponsored to go to camp while they're experiencing homelessness. And so they get to do fun activities like go on field trips. And then in the afternoon, they go to the Boys and Girls Club. And so they're doing things like swimming and archery and just
you guys
fun
sent us so many
things.
pictures back, too. It's great seeing the kids actually engage and have
Yes.
fun. And what I like, though, is, we've been doing this several years with you, but for the last 2 years, you've turned into more than just the camp. Now it's actually a year-long program, right?
Yeah, they're able to go to that camp all year round with their family, even after they leave Open Door Mission.
Nice.
And something we talk about is our kids are going through a lot of trauma, experiencing trauma, what led them there. And for them in the summertime to just forget about all the troubles and just be able to be a kid and have fun, that is just so precious, and we appreciate your help in sponsoring these kids.
It's a great cause, and we're blessed and happy to be able to do so. So, your second major campaign, we have also participated in several years, and this year we were able to increase our usual donation gift, and we just had our Radiothon this week, and we were blessed to be able to give you guys $10,000, and the listeners and some of our clients called in and matched that. So
Yes.
you guys had a very successful day.
Yeah, we couldn't do it without you because honestly, you're a double blessing when you challenge others to give when you match it. It does encourage others to do it. And everyone knows that this year has been extra challenging for people. And we're seeing that firsthand with people coming to our outreach centers. Our services are up 10%, donations down 7%.
Well, no, with inflation about 26% the last 4 years on household goods, the needs have never been greater.
Yes.
And we, and not only here, but I've got friends that support other charities similar to you in other cities around the country, and food pantries, et cetera, are being really pressed right now. And that's simply because those costs have risen on people, and then now we're starting to see job cuts mount, and unfortunately, people that have done what they think is the right thing, they just find themselves in an unfortunate circumstance. And so
Right.
what we want to do is, I'm always a big believer in a hand up versus just a handout. That's kind of my
right.
mentality on giving.
are we.
And you guys do such a great job. Absolutely. The mission there is so great. And on top of that, it doesn't hurt that you go ahead and share the gospel with these folks.
Amen. Yes, we share Jesus every day.
So-
And we're empowering folks to have Thanksgivings in their own homes and empowering them to want to be better.
No, absolutely. And I think you guys get the cost of a meal down to like like $2.40 or something.
$2.15.
Nice. Yeah. So, well, I was counting the inflation I was talking about.
Yeah, get back to me
But
next
if you're
year.
still doing it for $2.15, then kudos to you guys. Very good, very good. So, so that was a really good success, helping a lot of people. And then again, there's other opportunities. So we also participate in your Christmas Bells program, and we have a box in our lobby where people can drop off gifts. Now, where can they go to get that list of things? Which I know, and it's not toys all the time, folks. Underwear, socks.
Yeah.
I mean, some basic things are really, really needed, right?
Yeah, our Christmas Bells drives really helps for those guests who come to us at the last minute. No one expects to be homeless or experience homelessness during Christmas. And so we want to have some items for them, and then they're much needed items that we always need. So that brand new underwear and the extra large gloves for men, $10 gift cards to Walmart and Target. They can get that complete list on our website, which is opendoormission.org. And then they can come by your office, I'm sure, to donate the items,
we put
right?
a box out by our Christmas tree, which we put up after Thanksgiving every year, and every year we've had clients come stuff that box full. So it's nice to see them do so, and the more that gets in there than our employees, which our head count just keeps skyrocketing here. So they come in and start feeling, oh, well, maybe I should bring some stuff. So it's really cool. And I love that, just like we're talking about the matching gift. When one person sees someone volunteer, it's amazing how someone else steps up. We had another one of our favorite charities, Samaritan's Purse. We do an annual, their Shoebox drive.
Yes.
And we did that just a couple weeks ago right here. And we had several of our clients come help us stuff over 100 boxes. They're going to go shipped around the world. And that's why I try to invite the clients in, because once one person does it, then somebody else feels, you know what, maybe I should do it. And so
Yeah.
sometimes we can prod somebody maybe who wasn't a giver to become a giver. And so I'm always preaching, hey, help people become a better steward of their own resources and time and money. And so that's one of the reasons we love supporting your charity, because the efficacy of every dollar we hand over to you guys goes so far. But it's not just money that can help, right? You have a lot of places that people that are listening right now can volunteer. Can you talk about
That's
the
right.
opportunities?
We always have volunteer opportunities, but we have those fun ones to do during the holidays, like our Toy and Joy Shop. That's where the parents can come shop for their kids for free, so that everyone has gifts under the tree. And it's fun because people will wear their ugly Christmas sweaters, which aren't so ugly anymore, right? They're really cute. And then like the elf ears and stuff, just make it fun with your team. And it's a great way to give back and really see firsthand like what your time is doing to help others, and see how many people who actually need help this year. It does make you feel good. And of course, serving those meals, not just on holidays, because we serve meals every single day of the year. So we need you every single day of the year. If you want to serve lunch or dinner, you can do that as an individual, as a family, as a team, as a business. It's up to you, but it all matters.
Well, we just had one of our advisors teaches a planned giving and charitable giving class. We just held those in the office this past week, and he was actually a guest on the show. I guess it was last week, and he comes in with crazy trivia and tries to stump me, and most of the time I get him. But he actually had one. I think I got the answer right, but we found out that if you volunteer an average of 4 hours a week, so if someone signed up for one of those regular shifts as just a way to get out of the house, get some exercise, one of our retired clients, there's a 40%, I believe it was, reduction in cardiovascular events. I mean,
Wow. We're going to have to start using that in our marketing.
So we need to get you that data and use it on the marketing. But people have a better, less hypertension, et cetera. And I don't have the whole stats with you, but I guessed it correctly last week. But anyway, so it's not only about the feeling you get from volunteering, the help that you're giving. It's actually beneficial to your health, literally. So you guys have the need every day because you guys you're serving meals all day, every day, right? You've got so many different places people can volunteer. So if they wanted to volunteer, how do they sign up for that? What's the best way to connect with you?
You literally just start on our website, opendoormission.org, go to volunteer, you fill out the application, and then once you're approved, then you can start self-scheduling yourself. One of the other places I wanted to mention you can volunteer that is a real need for us is our outreach centers, and that's where we give out those food pantries, and then any household items, toys, gently used items that you donate to us, that is put there in that store. And so the people in our community that come shop there and get their food pantry, they can take those items for free. So it's really, you're helping out just by getting rid of stuff that you no longer need, and then you come volunteer and you can help give that stuff out, because we always need help there in our outreach center.
So there's so many opportunities, folks. If you're out there and wondering, hey, maybe I could, you can volunteer one time, do a one-time shift, or you can volunteer regularly, we're talking about, and reap the health benefits that you can get, or you can simply monetarily step up and help out a great cause that really takes the dollars pretty far. I believe it's about 90 cents or better better on the dollar that you guys actually get to the end cause. So you guys are very good on managing the admin side of the expenses, et cetera. And obviously, you're shopping well if you're serving up dinner for Thanksgiving for $2.14 or 15 cents. That's pretty darn good. So what else can you tell our folks about Open Door Mission here in the minute or so we've got left that you would like them to really know going into this holiday season?
Well, I just want to point out that during the holidays, a lot of people do think of us and think of coming to volunteer or donating or giving of the items during the drives. But January is going to hit, and there's still going to be people really experiencing that hardship and are going to need help. And that's where we would just ask that you remember us. And remember those people who are
the needs are year-round,
yes,
clearly.
That remember those people who are experiencing homelessness and poverty, and that when we come together, we just live in such a generous community that we all help each other. And we couldn't do it without generous partners like you in our community.
We are blessed to live in a very generous community. Omaha in general does a very good job of supporting so many great causes and charity organizations. Again, what's the website they need to go to?
opendoormission.org.
All right, opendoormission.org. That's all the time we have for this segment. Kristen, thank you for stepping into our new studio. It's your first time in our new studio.
It is so nice.
So we'll keep that going, and we'll look forward to hearing some of the results on how the holiday giving went. So, Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, the first question is about IRA RMDs, required minimum distributions. I'm hearing that when it comes to required minimum distributions, the rules will tighten for IRA beneficiaries in 2025. Is that true?
Okay, the rules have already changed. And so we need to point out RMDs, required minimum distributions, are not on just IRAs. It would be on 401ks, 403bs, any of these tax-deferred accounts you've been saving dollars in potentially has an RMD. Now, there's a bunch of rules, and we'll kind of explain it. But the questioner is talking about beneficiaries, so not the actual account owner. So the real easy way to understand this is if the person that owns the account, the original IRA holder that passed away, and you're now the beneficiary, you're going to inherit this account. If they started taking a required minimum distribution, they hit the age, and there's 4 different ages there, but if just real simple, if they are taking RMDs, they're required to take them, you are now required to take them. Okay, and so basically we have a 10-year rule. There's a few exceptions to that we can do a stretch IRA, very few exceptions, or there's a few exceptions where we have to take it out in 5 years. But most of the time, 95% of those that are listening, when they inherit mom or dad's IRA typically, they're now going to have to take RMDs, and they have 10 years to deplete the account. Now, it doesn't mean you have to take 10% each year. There's a calculation on basically how old you are, but it's going to be between 4 and 15% of distribution based on the age of the client when they inherit it and the age of the person that was deceased. But in the 10th year, this is what's really important, Chip, the account has to be emptied. So if you only took a very small distribution, 4 or 5% each year, and the account kept growing, you're going to have a very large sum of money in there, and that 10th year is going to put you in the very top tax bracket. And most likely you're probably in your retirement age yourself then, which is going to cost you significantly more for Medicare Part B, Medicare Part D, not only for you, but for your spouse if you happen to be married.
You don't know what you don't know, and you might get blitzed and blindsided.
Then we have to understand too is if you happen to pass away when you're the beneficiary of an IRA, then we have what's called an inherited IRA, and it gets really complicated there. And so it creates tax nightmares for folks. There's real problems even if minors, like some people are like, well, my kids are fine. I want to leave my IRA to my grandkids. This is very common. People tell us is like, well, we can do that, but it's a tax nightmare because they are now going to have to file tax returns if they're 8 years old because they're going to have to take distributions, right? So we want to talk about if that's a good idea or not, et cetera. But this is why you need to work with a competent, holistic financial planner that's not just going to help you pick investments. They're going to help you actually tax plan, distribution plan, and put the whole plan, the legacy plan together. And we want to make sure that your beneficiaries listed on your accounts, Chip, this is really important, match your wishes. A lot of times people have a new will drawn up. They have their trust documents. We recommend people review that every 3 to 5 years, and then we refer them to an attorney. Almost every client that comes in, we're going to refer to have their current setup of documents reviewed or get a set in place. But those documents need to match the beneficiaries on your account statement because whatever you list at your account, like if you've just had a 403B at Vanguard or something, and you started that 20 years ago, and you weren't even married at the time, and maybe you listed your brothers or sisters as your beneficiary, then you got married, that money's going to your brothers and sisters, not your spouse. The beneficiary list on the account supersedes your will, and it's very important that we look at every piece of this, how to take it out, when to take it out, why to take it out, and how you'll be taxed on it.
David, this next question is one that comes up frequently. We have about 2 or 3 of this species of question over the course of a year on the show, because most of our clients had a financial advisor before they signed up with Retire Smart. So it's a very real issue. It's about switching financial advisors. And here's the question. I love what I hear about your report card and your approach, but my brother-in-law is our advisor, and my wife simply won't entertain meeting with anyone else. She says we can trust her brother to take care of us. I like him, but this is our one and only retirement. I'm not sure we have the best possible plan. What's a guy to do here? Well, sometimes you have to be a quasi-marriage counselor, David. Is this one of those occasions?
Yeah, well, it is a reality, right? And sometimes people would prefer to work with a relative they work. Now, one of the things that I think is refreshing at our, like when we recruit advisors on our team, a role we ever expanding our team, our advisors, one of the things that they find so refreshing, I never ask them to go prospect their family or friends. We don't prospect the employees. Hey, we find that like where I go, the church that I go to, we have several clients that go there, but I've never hey, you should use my service. That would make me feel weird if somebody wants that, and I don't want any of the clients personally where I go to church, so I refer them to one of the advisors on our team. I'm not going to handle them because I would never want to have that odd conversation. And hey, let's face it, if something were awry in your plan, is that going to make it for an awkward Thanksgiving? I don't know, but the reality is, you need to do what's best for you. You don't do what's best for your brother-in-law. Do what's best for you. So what's the worst that could happen if you went out and had someone take a look? If you got an evaluation from a reputable third, it doesn't have to be us, but a reputable third-party firm to just show you things that maybe you're not being presented. And then the other thing that we always point out is we find a lot of folks are paying a full advisory fee to their advisor, but they're only getting 1 or 2 areas of what we call service. In other words, there's 5 key areas we believe wholeheartedly in that make up a successful financial plan. We got an income plan. We have to have it written, inflation adjusted to know your income's covered. Then we have to do legacy planning. We have to make sure that your status is covered. We were talking about that. We have to look at your medical and healthcare issues. Are those covered in there? Risk management, portfolio management, tax planning, all these go into a plan. But most advisors are charging a full fee, and they're just doing investment management and maybe risk management. And that's where we see it stop. So, sometimes I just ask people, how'd you get comfortable paying a full fee when you're only getting 20% of the work? So are you getting the type of advice you really think you need and deserve? The other thing is somebody may have been a great advisor to invest your money along the way, and that's just somebody who's choosing investments.
The accumulation phase.
Yeah, and that's a different skill set. They're just choosing investments to grow while you were maybe 15 or 20 years out. But now that you're arrived at retirement, you may need a different type of advisor. I kind of always put it akin to when you go to the doctor, right? When you were young, you were probably going to see a pediatrician, a specialist in your age bracket. As you got older, you went to a family physician typically, and as you get older, you end up seeing mainly like internists or geriatric doctors, et cetera. And if you unfortunately get a certain disease state, cancer, you're not going to go to the pediatrician. You're going to go to an oncologist. You're going to see a specialist. And it's the same thing when it comes to financial advice. So you need to tailor what you're looking for and make sure who's giving the service meets your needs. And it does, your brother-in-law may be able to provide this. We don't know. I don't know where this person works, et cetera. But what's the worst that can happen if you were to go see what's missing? And then you can even go back to your brother-in-law, hey, can you provide these additional services? And it's a pretty easy find out. But I always tell people, don't worry about choosing us. Don't worry about choosing your current advisor. Choose you.
Well put. One more question, David. Hey, you mentioned the Buffett indicator earlier in this show, and that's the focus of this question. This caught my eye because I have heard you talk about the Buffett indicator. A news story said the Buffett indicator hit an all-time high. What does that tell us? David, maybe you better first remind folks what is the Buffett indicator, and then tell us about this latest reading.
So what's referred to as the Buffett indicator is it's what's called the Wilshire 5000. So this is looking at the top 5,000 publicly traded stocks, which is over 90% of the publicly traded stocks in America. So not only the New York Stock Exchange, the NASDAQ, the American Stock Exchange, the Philadelphia Stock Exchange, et cetera. So basically, you're looking at just about all publicly traded companies. And what you're looking at is the Buffett unit. What's the value of all those companies, right? So if we put up the market valuation, their stock price times the amount of shares they have, gives us a valuation, add up all 5,000 companies and puts a valuation. Then we look at what is GDP, gross GDP in America for a whole year. And so basically, if the value of the stock market as a whole, the Wilshire 5000, is less than America's GDP, according to Warren Buffett, stocks are undervalued and you should be an investor. If it's over that value, they may be overvalued, right? So you may want to be more specific in what you invest in, not in the broader index. In other words, you'd want to go find the pockets of value. Well, that number has been rising, the Wilshire 5000, and we talked about that earlier because the index and passive investing that's going on today, and it not only is it over 100%, Chip, it recently crossed 200%. And as of this week, 202%. Yeah, so we have a chart that we can probably put on the YouTube channel that shows you how high this thing is valued. And so the stock market, from any reasonable standpoint, is extremely overvalued. Now, doesn't mean it can't run higher. It can go significantly higher. The stock market was extremely overvalued in the late 90s and kept pushing for 2 more years before it finally cracked. But the problem is when it goes this far, Chip, when it cracks, the crack is pretty severe and it goes backwards pretty fast.
Up next, corporate insiders are unloading company stocks like never before. We'll explore what that means next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, you sent the team a chart about insider selling. Now, when I hear insider, I think of sneaky politicians cashing in on legislation in advance, since they know that's not what we're talking. We're talking about CEOs. We're not talking about anything nefarious here, but it is nonetheless a trend that caught your eye. Tell us what's going on here.
Yeah, so those in the C-suite, if you will, those in the know that are major shareholders of publicly traded companies are selling their shares at almost an alarming rate. So it's the ratio has never been higher. So the insiders selling while the market's at all-time highs. Retail investors, we've had this Trump bump. It's been primarily retail investors been the buyers, and insiders are actively selling into that bump. So all it is a cautionary tale. Is when insiders aggressively start to sell, it doesn't top the market, but it tells you a turn may be coming at some point in the near future, simply because they are deciding to cash out. Now, there's legitimate reasons. Typically, those that have significant wealth, I'm talking like Jeff Bezos and Elon Musk, they almost always have just a structured selling plan to just diversify their assets, as they should, because their net worth just becomes so beholden to the companies that they're in or work for. So, but when that number starts to push up, as it has here recently, that can be just a cautionary tale that maybe they don't believe the future is as bright. And as I mentioned earlier in the show, earnings estimates for the S&P 500 continue to drop over the last year. We've seen the estimates for 2025 go from almost $300 collectively down to $274 for the S&P as a whole. That's about a 10% reduction in the growth of earnings. So, and earnings is ultimately what drives, the valuations and what we're willing to pay for stock. So again, they're just saying that the stock market is probably closer to the end of this run, obviously, than in the middle and the beginning stages. So just be careful. It's just a cautionary tale.
Another chart you sent the team, David, was about retail sales, and there's some pain in that chart.
Yeah, so we actually went negative retail sales this past month, and so that is showing you that the consumer is really strapped. And on top of that, so we just had the 2 biggest retailer big boxers report this week. So we had Walmart report earnings on Tuesday of this week and Target on Wednesday, and a tale of 2 different cities there, right? So Walmart had really actually increased their earnings by about 4%, doing better than expected. But what was really interesting when we went through the earnings call, and I actually was on it, is they talked about the $100,000 income level and up. The amount of increased foot traffic that is shopping in Walmart is incredible. So all their sales growth came from higher income people. In other words, we see this when we're typically heading into recession. People that maybe have a little better off income opportunity are downshifting where they choose to spend their money.
Well,
right?
Let me shoehorn in a headline you sent me from CNBC. Target shares plunge 15% after discounter cuts forecast, post biggest earnings miss in 2 years. And one of the aspects of this story is, they're instead of going to Target, they're going to Walmart.
Exactly. And it kind of Target's typically just thought of as a little bit nicer store. So we're seeing that downshift in the economy. We saw this in 2007, before the economy had cracked. But the consumer is definitely showing signs that, hey, look, we're going to be really tight with our spending here. There's auto delinquencies right now on the rise. We've got, there's all kinds of issues that are showing us that the consumer may be at a tipping point. And this data just shows it. And I just thought it was funny because we had Walmart Little report before the market opened on Tuesday. In 24 hours, Target reported, and two completely different forecasts and pictures of what's going on. And what we're seeing is when we get into recessionary times, people will downshift what they're going to spend money on, right? So it makes perfect sense. And the benefactor, if you go back 15 years ago, we saw things like Dollar General and Dollar Tree. Those companies really expanded because they serve, a lower income component. They're in rural America more. And so people are downshifting where they're spending.
Boy, if I'm a retailer, am I getting nervous as the holiday season approaches?
Well, not only that, you have to add on top of that the advent of the convenience of Amazon, right? 10 years ago, Amazon delivered stuff, but now it's everywhere, right? Rural communities use it. And so Amazon has stolen the thunder of many retailers as well. So you're going to go shop where your dollars get the biggest bang for your buck, right? And that's just what we're seeing.
Let's go global again for a moment, David, because the laws of economics apply everywhere all the time. It has nothing to do with race, ethnicity, nationality, and this is playing out in China. You sent the team a chart showing that stimulus is failing in China.
So they are trying to get their economy fired back up. They had we've talked about it the last 2 years, major real estate crisis over there, right? And that has depressed their economy. Their economy in general is down. And now with the Trump election, they immediately fired off another $1.6 trillion in stimulus because they know the Trump bump, the Trump effect, right? More things are going to be manufactured in America. That's what happened the last go around, right? So just forecasting, they know that this is probably detrimental to their export economy. So how do they fight that? Well, they fire off stimulus. Now, China does not let their currency float naturally. So we believe they're going to continue to fire that bazooka, which could stimulate growth, and there may be an opportunity in the short run in China to make money for American investors. But this is a cautionary tale of the global political world we live in, right, and global trade, and the tariff talk and all this stuff is going to come back into, and so why it's so important that we learn the Treasury Secretary this week because of that very conversation. But yeah, I would tell you that if China's economy is suffering, obviously, they're the second biggest economy in the globe. That is a major concern for global trade, and if we're going to head into a global recession at some point.
Well, and the data here says we're not talking about a blip. This has been going on for a year and a half. This is 6 consecutive quarters that China's been struggling.
Well, we talked about it because they started with the real estate collapse. They went
Evergrande comes to mind.
Yeah,
Isn't
absolutely.
That the big company that?
And so they literally demolished 24 different sets of high rises that they'd built. They just destroyed them to try and make it where there'd be less inventory. And so when you have too much capacity, prices drop rapidly. And all you have to do is look in Austin, Texas, Miami, Fort Lauderdale, Tampa. Inventory on Realtor.com is up 200% year to date, right? So inventory is flooding the market here, which typically will suppress prices, real estate prices, et cetera. So these are all things we're watching to see how the economy will fare. Like I said, I think under this new presidency, we're going to have some unique opportunity for economic output to grow. There may be tax cuts on the corporate side coming in. They may extend the current tax code where we have known as the Trump tax cuts. All this would be positive for the economic side of growth, but it'll be negative for the debt side of our balance sheet. And that's things that are concerning me right now.
David, in the time we have left this week, I want to focus on something that you sent me from Advisor Hub. And this just sent a chill down my spine working in this industry, financial planning. The headline is, Stifel ordered to pay $2.4 million over Miami brokers' structured note strategy. And apparently that comes on the heels of a $14.3 million fine that Stifel was hit with a month or so ago. There's a cautionary tale here, David.
So what happens is advisors now have the ability, and we have the ability, we just choose not to do it. You can build these customized notes, and they're backed by the by the faith and credit of the bank that issues the note. But what it is, it's basically a note that is then going to be tied to a stock in particular, or a basket of stocks, or even an index. And they pay a really heavy coupon, so it's an income-producing instrument typically. So let's give an example. If you wanted to buy a note on Apple, they may give you a 3-year note, and they guarantee you 11% income on that note. Well, 11% sounds really good, right? However, if Apple, the underlying stock, were to go through a barrier, typically 30 or 40%, whatever they put on there, down in price, you now have to buy the stock and the coupon stops paying, but you still own it for the 3 years. And they're structured in a myriad of ways. The problem, and these actually can be useful if designed properly as a small percentage, but the problem is this advisor here went and designed a little things that were not structured soundly. He designed them, didn't have the wherewithal, the education to design them. They weren't designed by the trading desk or what have you. And he put a lot of clients' money in it, and it turned out badly. And so those clients turned and then sued their broker-dealer, et cetera, and this was the settlement that they've got. So the cautionary tale is if your advisor is selling you nothing but these structured products, as they're called, or structured notes, you need to understand they are not fully guaranteed. They say that, hey, it's a note, we'll give you your money back, but it's backed by the principal, or there's barriers or triggers in there that mean your principal is no longer safe. They're not FDIC insured, et cetera. So you need to really understand the products that are being offered. My problem with it is then if an advisor, and we actually saw a statement come across our office recently from an advisor that basically is charging people, I think it was 1.5% a year advisory fee, but he put some of these products that cannot change for 3 years. Well, how is he actively advising this client? So that makes me not misunderstand. I believe that he's should not be charging that fee. So he's charging the client a fee on top of that when there's nothing to manage. This is set in stone.
Autopilot for
it's
3
on
years.
autopilot. Yeah. So just be careful if that's the stuff that your advisor is doing. The cautionary tale is just understand. If you don't understand what's in your portfolio, maybe you shouldn't own it. And have your advisor explain fully, to what you have, and make sure you're comfortable with it.
That's how we operate here, folks. That'll do it for this week. Please visit our events page at retiresmartomaha.com to see everything we currently offer. No charge, no obligation for our events, but you need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Thank you so much for our loyal listeners out there. Show 350. We are having a blast, and hopefully we'll keep doing another 350.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. Kristen Dineen is not a client, nor is she affiliated with Retire Smart, and was not compensated for her appearance or any implied endorsement. Open Door Mission is a nonprofit 501c3 organization and is not affiliated in any way, nor is it a client of Retire Smart. However, Retire Smart has made charitable donations to Open Door Mission.